Let's stay on bonds and stocks and the markets because we've got new highs across the board for equities. Nearly all major averages on pace for new records. The market seems to have adjusted to tariffs, but what happens if the Supreme Court rules that the tariffs are actually illegal? Would that hurt America's massive debt load? Let's talk about that and more. Joe Lavorgna is well known to our audience as a markets guy, but now serves as counselor to Treasury Secretary Scott Bessent. Joe, good to have you on the program.
Thank
Yesterday,
you, Brian.
You're very welcome. Yesterday, the Federal Reserve cut its overnight lending rate, but as we just showed our audience, bond yields are actually going higher today.
Yes.
Put your market man hat back on. What's going on?
They're a little bit higher, Brian, but not much. Mortgage rates actually now are down to almost their lowest in about a year. They're still too high, but they're coming down. As inflation drifts lower, Brian, and as the Fed gets down to neutral, even the Fed's forecasts do show the Fed eventually moving to neutral. That should help lower mortgage rates. And another thing that's helped a lot, of course, you highlighted about tariffs. The tariffs are raising a record amount of money. And as much as people were worried and nervous about U.S. assets back in the spring, what's remarkable is if you look at estimated term premium across the G7, it's actually fallen in the U.S. It's lower than almost everywhere else. And that over time will also allow interest rates to come down because the U.S., thanks to President Trump's policies, is getting a more sustainable fiscal footing.
Yeah. Listen, obviously, Stephen Myron's dissent, the 0.5 percentage point cut suggestion, that got a lot of attention. Some people say his sort of dual role for now in the White House and the Fed is not only unprecedented, but it's unfair. Your response?
I mean, the thing is, last year at this time, the Fed cut 50 basis points. You look at the inflation backdrop, very similar. Chair Powell's supercore virtually no different today than it was a year ago. The trend is lower given the fact that there's more supply coming onto the economy because of the one big beautiful bill, and things like rents are moderating, food and energy costs are down. But the Fed did cut 50 basis points. At the time, Brian, the 3-month moving average on non-farm payrolls was 116,000. Right now, it's 29,000. The economy that the Trump administration inherited was nowhere near as robust as people thought it was. The labor market was actually quite weak heading into January when the president took office, and yet the Fed only did 25 basis points. I can't speak for Stephen on this, but I understand why he would rationalize a much bigger recalibration of rates. And by the way, the Fed even said itself it expects to cut rates further this year.
You said the other day the Congressional Budget Office keeps getting some of their estimates wrong. The BLS administrator has been fired. Some people say the inflation data is garbage because it doesn't really reflect things like, auto insurance and things that people actually pay. How much, Joe, should our audience trust government data right now?
Look, the CPI I don't think has the same problems that the payroll data have. Brian, in the last 3 years, if you exclude the brief period around the election last year, about 86% of the time, the payroll data have been revised down. They've been revised down by a record amount. Before I was lucky to take this role working with the Treasury Secretary, there was a lot of consternation on Wall Street that they couldn't trust the payroll data because it was too volatile. It's moving in one direction. So there certainly needs to be a more wholesale approach of how the data are collected. Broadly speaking, as it relates to forecasts, though, I've argued for quite some time, and I think many are sympathetic to it, the CBO's estimate of potential GDP is much too low. They've got the economy growing under 2%, which makes no sense. It's not consistent with President Trump's first term. It's not consistent with the supply side initiatives that are in the bill that was passed in July. We're seeing a CapEx comeback. We've seen very strong strength in blue-collar wages, which means faster productivity. That's just not the stuff, Brian, of sub-2% GDP. In fact, right now it looks like it's going to be 2 quarters in a row of 3% growth. So if you're in that kind of world,
what's wrong? How do we fix it?
So I think the thing is, well, we fix it. We have to slow the pace of spending, which the bill did. But importantly, we've got to have realistic assumptions on what the growth is likely to be, because that you could plan the future on. And when you're assuming such weak growth, you're going to get very poor fiscal outlook. Now, fortunately, the growth will be stronger than what CBO's got. And the tariffs are raising a record amount of money, and the CBO actually may be right on this one. They think they could lower the deficits over a 10-year period by $4 trillion. So customs duties, the tariffs we're collecting, that is very central to putting ourselves, Brian, on sound footing, and that's one of the reasons why rates in the U.S. have come down. whereas I said at the outset, they've gone up almost everywhere else in the world.